lots of reasons for a company to buy back its own shares of stock. Maybe they want to increase earnings per share by reducing the number of shares out there. Maybe they want to exert more control over their company themselves, or maybe they just want shares to be able to give to their officers for stock options. The key to treasury stock purchase and sale is that we never want to record gains or losses when we resell that treasury stock, because we need to be focused on our business, not on the business of buying and selling our own stock. All right, let's take a look at this problem here. Sanjam Marketing Corporation had a draft of their stockholders' equity section here. This is before they account for some treasury stock that they repurchased and some of that treasury stock that they resold. Notice how all these accounts have credit balances except for the account treasury stock, which has a debit balance. And in this example, we're going to use the cost method of accounting for treasury stock. There's a more complicated method called the par value, but virtually nobody uses that. The cost method is by far the most common. So during the course of the year, they bought back $34 million of treasury stock, and then they resold some of that for $15 million. The shares that they had resold for $15 million had only cost them $6 million. So in a sense, they made $9 million, but we don't book gains or losses on the sale of our own stock. Let's first do the journal entry for the repurchase of the $34 million of treasury stock. Super easy in the cost method. What's happening to cash? It's going down. Cash is an asset. Assets decrease with credits. So we're going to credit cash for $34 million. Hence, we must be debiting treasury stock for $34 million. And that makes sense because we said that treasury stock has a debit balance. Now let's sell for $15 million shares that cost us $6 million. Cash is an asset. It increases with debits. Treasury stock increases with debits and decreases with credits. So we'll take that treasury stock off our books. We paid $6 million for it, so we'll credit the account treasury stock for $6 million. Now that journal entry doesn't balance. Our first instinct might be to book a credit called gain on sale, just like we do with a fixed asset. But we don't book gains or losses on the sale of our own stock. The FASB, the IRS, our shareholders don't want us booking gains and losses on the sale of our own shares. They want us focused on running our business, not on manipulating our stock price so that we can make money on treasury stock. So instead, we credit this unusual account called paid-in capital treasury stock. If we had credited an account called gain on sale of treasury stock, that would show up on our income statement and would eventually close into retained earnings, which would eventually increase our equity accounts. But we don't do that. Instead, we directly increase our equity with a credit to this equity account called paid-in capital treasury stock. So the key to this lesson is we don't book gains or losses on the sale of treasury stock. And then if we sell treasury stock at a loss, we'll use up any balance that's in this special account called paid-in capital treasury stock until eventually it's all used up. And then if we sell shares at a loss after there's a zero balance in that paid-in capital treasury stock, we'll debit retained earnings directly. We'll decrease retained earnings, but we won't run that loss through the income statement. We'll just debit retained earnings directly. So we just answered the part of the question about recording the purchase and resale of the treasury stock. Overall, how much did stockholders' equity increase or decrease as a result of the two treasury stock transactions? Well, equity went down by $34 million when we bought back those shares and went up by $15 million with these two credits to equity accounts. So equity went down by 34, up by 15. So that's a net decrease of $19 million. Let's post these journal entries and prove that. Okay, we posted the debit to treasury stock for $34 million. We posted the credit to treasury stock for $6 million when we resold those shares, quote unquote, at a profit, at a gain. We also increased paid-in capital treasury stock by $9 million. So when we strike our balances here and post them to our revised partial balance sheet, our total shareholders' equity has gone from 3151 down to 3132, which is a decrease of $19 million, which is exactly what we predicted when we looked at the numbers rough and ready. I hope that helps.